Welcome to the Deep Dive, your shortcut to being well-informed. Today we're going to cut through the noise to really unravel a fundamental concept for understanding market movements. We're talking about the dealing range and its essential 5-rule checklist. Our source material for this deep dive, it comes from some really compelling excerpts of an online teaching session, specifically a rule card episode, Dealing Range, 5-rule checklist. It's quite a fascinating exchange, between a teacher and a student, and it's really designed to provide a clear blueprint for market analysis.
And that blueprint idea, that's exactly why this matters so much, right? Truly getting a handle on your dealing range in the market, well, it isn't optional. It's foundational. Without it, you're basically just guessing where price might head off to. And more importantly, you miss the crucial why behind the moves. This isn't about random speculation. It's really about gaining a precise, rule-based understanding of how these markets actually operate.
Absolutely. So our mission today is to distill the absolute core insights from this teacher-student dialogue. We want to give you a clear path to effectively define and utilize your dealing range. Think of it almost like mapping out the market's intentions. Let's get started. Okay, let's dive right into rule number 1. The teacher immediately establishes that a dealing range isn't just some arbitrary guess you make. No, it's meticulously anchored by clear swing highs and swing lows. We're talking precision right from the very beginning, defining your exact playing field. And the source material is super clear on how these anchor points are precisely defined. It uses a simple 3-candle pattern. Okay, so for a swing high, you're looking for a middle candle with lower highs on both sides. Easy enough. And conversely, for a swing low, it's a candle in the middle, but with higher lows on both sides. The point is, this isn't open to interpretation. It's laid out as a fixed, repeatable blueprint for identifying them. The teacher's instruction on this, incredibly direct. Here's what they say.
Swing highs and swing lows are simply just 3 candles. Okay, 1 candle in the middle, lower high to the left, lower high to the right. That's a swing. High candle in the middle with a higher low to the left and higher low to the right is a swing low. Very simple. Now the dealing range low is down here. Okay, so given that strict definition, what's the biggest pitfall someone might run into when trying to spot these anchor points in real time? And how does sticking to this 3-candle rule actually help prevent those common mistakes?
That's a really good question because this precision is just paramount, the biggest pitfall. Subjectivity, plain and simple. People tend to, see what they want to see, or they might mistake minor little wiggles for significant turning points. This 3-candle rule, it just removes that guesswork entirely. It acts as a non-negotiable filter. If a formation doesn't meet this specific pattern, well, it's not a valid swing, high or low, for defining your dealing range, period. And this prevents you from drawing a range that doesn't actually align with the underlying algorithmic structure of the market. It makes sure your foundation is genuinely solid and consistent every single time.
Right? Build it right from the ground up. Makes perfect sense. So once you've got those precise high and low anchor points nailed down, rule number 2 kicks in. This is identifying the equilibrium, which is, simply put, the 50% midpoint of that dealing range you just defined. The teacher describes this level almost like a magnet, a point where price tends to gravitate back towards. And the teacher lays out exactly how to find this key level too. Should it trade higher to at least equilibrium at this high and that low? And the way you find that is to simply put a Fibonacci retracement from here to here and post it with the 50 level. So we want to see price try to gravitate back to 50%, which is equilibrium and or preferably higher. Okay, so why is marking this exact 50% level so critical then? How does knowing that midpoint fundamentally change how you understand where price actually is within that range?
Well, what's fascinating here is how this seemingly simple calculation actually unveils a deeper market truth. See, that 50% mark tells you whether price is trading at a premium that's above the midpoint, so more expensive, or if it's at a discount below the midpoint, making it cheaper relative to its current dealing range. Algorithms, they're designed for efficient price delivery, and they often seek out this equilibrium point, this 50% level, to sort of rebalance orders. Understanding this gives you a really powerful predictive tool. It helps you anticipate where price might pause or maybe consolidate or potentially even reverse. It's not just some line on a chart. It's effectively the market center of gravity for that specific range, and that provides crucial insight into the probable next moves of, well, the larger market participants.
That idea of market intent is really powerful, isn't it? Which brings us very nicely to rule number 3. So you've got your range defined, you've identified equilibrium. The next step is figuring out where price is likely to go next. We're talking about its draw on liquidity. This isn't about wishful thinking, it's about having a clear, specific target for price. The teacher identifies these targets as low-hanging fruit objectives. So is it an old high, an old low, Or maybe a fair value gap. Now, a fair value gap, just for anyone unfamiliar, it's essentially a price imbalance you can see on the chart. It's like a gap where price moves so fast that orders didn't get fully filled. This creates a kind of void that the market often wants to return to fill in later. And the teacher really emphasizes that without a clear, specific target like one of these, any trade is basically just aimless speculation, as the teacher explains it. Then you're going to look for the imbalance in price, which is that fair value cap. Then you're going to determine where an opposing high or low resides, then log and backtest the number of handles you see in hindsight examples.
And just quickly, when the teacher mentions handles there, you can think of it as a specific measure of price movement, like a certain number of points or maybe pips, depending on the market. So how does identifying this specific draw on liquidity actually transform your approach? How does it shift you from just reacting to, well, anticipating? And why is having that specific logical target so crucial?
Yeah, this rule is absolutely fundamental for disciplined decision-making. It really is. If you don't know where price is trying to go, every little market movement just feels chaotic, right?
Right.
Random. But by identifying a clear draw on liquidity, whether that's an old high or an old low, or maybe one of those fair value gaps, you're essentially mapping out the market's most probable path. These are areas where, significant liquidity exists. Where institutions likely have orders waiting, that makes them almost like magnetic targets for algorithmic price delivery. So it shifts your mindset. You stop just reacting to price wiggles and start proactively anticipating its movements. It provides a framework not just for, say, finding an entry, but crucially for figuring out where price might logically be expected to reach within your defined range. It's all about finding the why behind the where for your potential profit objectives. Makes sense?
Total sense. That distinction between just speculating and actually anticipating is critical. Okay, let's move to rule number 4. This one introduces a component that might be less obvious but is just as vital. Time filters, often called kill zones. The teacher really hammers home that price delivery isn't random, it's actually time-sensitive. It's governed by precise algorithms. So this rule is all about knowing when to expect certain price behaviors to unfold within your defined dealing range. The teacher details some very specific time elements, and these are just suggestions, okay? They're framed as the market's algorithmic clock, the times that dictate where and when price gets delivered. We're talking about things like the midnight New York Open, the 8:30 a.m. news releases, those 10:00 a.m. macro events. These are typically periods of high institutional activity where the algorithms are most likely to execute whatever their predetermined intent is. Listen to the teacher's precision on this point. What is the opening price at New York midnight? That's this candle. That's the actual price I'm looking at, and I'm drawing that out in time. How far am I drawing it out? At 11 o'clock in the morning, New York local time.
And they go further, emphasizing the importance of blending time and price. Your time filter is 10 a.m., so at 10 in the morning, put a vertical line on that. If there is an algorithm, it would refer to things like this very specific time element first, and then price elements, and when you blend those two together to get a narrative. So how does layering these specific time filters onto your price analysis really elevate the probability of your market insights? What's the magic there?
This is a really profound insight into the actual mechanics of institutional trading. Time acts as this incredibly crucial filter. It can turn what looks like just a potential opportunity into a genuinely high probability event. See, institutional order flow, it isn't just haphazard. It's often scheduled around these kill zones you mentioned, key session opens, news releases, or specific hours when the major market players are most active. So by understanding these time elements, you're not just waiting for price to maybe hit a certain level. No, you're waiting for price to hit a level at a specific time when those algorithmic drivers are most likely to, execute their intent. It's this synergy, this blend of precise price analysis and critical time windows that creates a powerful narrative. It gives you confidence that your anticipation actually aligns with periods of maximum efficiency and institutional influence in the market. It's really about leveraging the predictable aspects of algorithmic design to your advantage.
Knowing not just what, but when. Yeah, that feels like a game changer. Okay, that leads us directly to the final rule, rule number 5, which brings us to the actual entry point. For your entry, the teacher instructs looking for a specific price delivery array, PD array. This is to confirm the move within your dealing range and make sure it aligns with your overall market bias. This isn't just finding any old pattern. It's described as the final algorithmic confirmation. The examples provided for what constitutes a PD array include things like a fair value gap, which we talked about, that price imbalance, or an order block. An order block that's a specific candle pattern, often indicating where large institutional orders were likely placed, which then led to a strong move away from that level. Or it could be an optimal trade entry, which is typically a specific Fibonacci retracement level within the range that often serves as a high probability entry point. The key is these PD arrays are described not as random formations, but as the precise footprints of the algorithm, telling you it's ready to execute its intent. The teacher lays out the context for these entries very clearly in the source. This is the 50-minute fair value gap, and it's trading down to an order block after a shift in market structure. Fair value gap with an overblock and optimal trade entry is the gold standard of the I-stick pattern that's taught on this YouTube channel. This is where you can be long and expect price to reach for here and here. And just for clarity, when the teacher mentions ICT pattern, that simply refers to the specific methodology or framework being taught on that particular YouTube channel. So how do these price delivery arrays act as that final critical piece? How do they bring all these rules together for a high probability entry?
Well, think of the price delivery array as essentially the algorithmic signature for execution. It's the final go-ahead, if you will. You've already done the work, right? You've defined your boundaries with those swing highs and lows. You've identified your equilibrium, that 50% level. You've pinpointed your target liquidity where price is likely headed. And you've timed your anticipation using those kill zones. The PD array then serves as the final high probability trigger. It's the market-specific signal, the exact point within that dealing range, where the algorithm is basically signaling, okay, I'm ready to move now. This isn't about chasing price around. It's about patiently waiting for all these conditions to align perfectly. And it culminates in these identifiable footprints, the PD array, that indicate where the algorithm is just about to deliver its intended price action. It really transforms the entire process into a very methodical, step-by-step approach. It replaces guesswork with precise, executable logic for finding a high probability entry.
So pulling it all together, what does this really mean for you, the listener? The teacher concludes that consistently following these 5 rules empowers you to actually see the market's true intentions. It creates a much, much clearer picture.
Exactly. You stop guessing and you start anticipating. And this isn't just some abstract theory, It's a really comprehensive framework. It's executable logic designed to separate consistent market understanding from, well, just being confused by all the noise. By integrating these precise rules, you gain a systematic method for analyzing market movements, one that's based on observable algorithmic design, not on random chance or subjective interpretation. It truly empowers you to navigate what can be very complex price action with, I think, remarkable clarity and confidence.
And as we wrap up this deep dive, here's something to think about. How might applying a precise rule-based checklist, like this one specifically designed for uncovering algorithmic intent in complex markets, how might that translate to other areas of your life, particularly areas where you face, say, information overload or complex decision-making? What variable data patterns might you be missing by not having a clear dealing range and maybe even kill zones for your own daily information flow? Whether that's managing your work projects or your personal finances, or maybe even just trying to understand the news cycle better, just something to think about.